Mistake 1, the $10,000 myth that gets good people into trouble. Most Americans have heard some version of the $10,000 rule from a friend, neighbor, or someone who sounded confident enough to be believed. The story usually goes like this. If you're depositing more than $10,000, don't do it all at once. And that's where the trouble begins. Banks are generally required to report certain large cash transactions. For most honest people, it's simply routine paperwork. But then people hear about the reporting requirement and decide they should avoid it. Imagine selling a vehicle and receiving $14,000. A well-meaning friend says, "Deposit $7,000 now. Deposit the rest later." Sounds responsible. But that decision can create more problems than depositing the money honestly in the first place. Because banks don't just look at individual transactions. They look at patterns. And when multiple transactions appear designed to stay below a reporting threshold, that pattern can attract attention. The irony is that the original money may be completely legitimate. Yet the attempt to avoid paperwork is what creates the problem. That's why financial professionals often give the same advice. If the money is legitimate, treat it legitimately. Deposit it. Keep proof of where it came from. The paperwork usually isn't the danger. Trying to avoid the paperwork is where people get themselves into trouble. And that's important because the next mistake involves activity that can attract attention even when no reporting threshold is involved. Mistake 2, the activity that doesn't match your pattern. Most people think banks only notice large amounts of money. That's not always true. Sometimes they notice unusual behavior. Imagine you've used the same account for 15 years. Your banking habits are predictable. Then one day something changes. Maybe you're helping family. Maybe you're paying for a major expense. Maybe you're moving money for a perfectly legitimate reason. The problem is simple. Computers don't know your story. They only know your pattern. And when a pattern suddenly changes, questions can follow. Not accusations. Questions. That's why a simple paper trail can be valuable. If money is moving for a legitimate reason, having records available makes it easier to explain what happened. The people who experience the fewest problems are often the people who keep the clearest records. Because when questions arise, answers already exist. And that brings us to a mistake that's becoming increasingly common as banks work to protect older Americans from financial scams. A mistake that can temporarily separate you from your own money. Mistake 3, the freeze you never see coming. Most people assume the biggest threat to their savings is a scammer. Sometimes it's the bank trying to protect them. Imagine walking into your branch and asking to withdraw $20,000. From your perspective, it's simple. It's your money. You know exactly why you need it. But the bank sees something different. A large withdrawal. An older customer. And a financial world where seniors lose billions every year to fraud. So the questions begin. Who is the money for? Did someone ask you to make this withdrawal? Has anyone pressured you? Are you sending money to someone you met online? The bank sees risk before it sees your explanation. The goal is protection. But that protection can sometimes create delays when a transaction suddenly looks unusual. The solution is simple. Before making a large withdrawal, call your branch. Tell them the amount. Tell them the reason. Tell them when you plan to come in. A 5-minute phone call can prevent a much longer conversation later. Because when the bank knows what's happening ahead of time, your transaction looks planned instead of suspicious. Mistake 4, the $250,000 number many retirees never check. This mistake isn't about fraud or taxes. It's about protection. Many retirees spend decades building savings. Then they place those savings in a single bank and never think about it again. After all, it's a bank. What could go wrong? The answer is simple. Very little, until something does. Most people know deposits at insured banks receive federal protection. What fewer people know is that coverage has limits. And many retirees never verify whether all of their deposits remain fully protected. Bank failures are rare. But rare doesn't mean impossible. The people who sleep best at night aren't hoping nothing goes wrong. They're prepared if something does. That's why one of the smartest financial reviews you can do this year takes less than 10 minutes. Review where your deposits are held and whether they're fully protected. If you're not sure, a quick conversation with your bank can often provide the answer. Mistake 5, the address mistake that can cost you thousands. This mistake begins with something completely ordinary. Moving. Maybe you downsized or moved closer to family. So you do what responsible people do. You update your bank. You update Social Security. You assume everything else is handled. But one important organization may still have old information. The IRS. Now imagine an important notice gets mailed. Not a refund. Not a routine letter. A notice requiring action. But it goes to your old address. You never see it. Weeks pass. Then months. Deadlines expire. Penalties grow. Interest continues accumulating. And because you never received the notice, you don't even know a problem exists. That's what makes this mistake so dangerous. The issue usually isn't the first letter. It's everything that happens after the first letter goes unanswered. Many retirees assume updating one government agency updates them all. Unfortunately, it doesn't. That's why making sure every important institution has your current address remains one of the simplest financial protections available. 5 minutes of prevention can save months of frustration later. And while this mistake can create expensive problems, the next one often creates family problems. Mistake 6, the gift that becomes a paperwork nightmare. Helping the people you care about most feels good. For many retirees, it's one of the greatest rewards of financial stability. There's nothing wrong with generosity. The problem begins when generosity leaves no paper trail. Imagine giving a large amount of money to a family member. Months later, nobody remembers the exact amount. Nobody remembers the date. Nobody remembers whether it was intended as a gift or a loan. A simple act of kindness suddenly becomes a source of confusion. That's why documentation matters. Not because you're expecting problems. Because you're preventing them. A simple written record can eliminate misunderstandings before they ever begin. Good records protect relationships. And when money and family mix, protection matters. Because the final mistake starts with family too. But the consequences can be much bigger. Mistake 7, the joint account created out of love. This is the mistake almost nobody thinks is a mistake. In fact, many people believe it's a smart idea. A parent wants help managing finances. Someone suggests, why don't you just add your son or daughter to the account? It sounds simple. And that's exactly why so many people do it. But what sounds simple can create risks that aren't obvious until much later. Because the moment another person becomes a joint owner, that account is no longer connected only to your financial life. It's connected to theirs too. If they experience financial trouble, legal issues, creditor problems, or a divorce, complications can arise that nobody anticipated when the account was created. And there's another issue many families don't discover until it's too late. When one owner passes away, the account generally follows the account agreement. Not necessarily the instructions in a will. A decision made at a bank years earlier can sometimes have a greater impact than instructions written in an estate plan. That's why many financial professionals encourage retirees to explore alternatives. One common option is a payable on death designation. With that arrangement, you remain the sole owner while you're alive. The people you name receive the funds after your passing. No shared ownership. No unnecessary exposure. And for many families, it accomplishes exactly what they hoped the joint account would accomplish in the first place. The tragedy is that most people don't learn this until after a problem appears. Which is why this final mistake deserves a closer look than almost any other item on today's list. Because protecting your money is important. Protecting your family's future may be even more important. Your action plan. This week. Review any large cash transactions. Verify your address information. Check your deposit protection. Review any joint accounts. Document major gifts to family members. 5 simple steps. Any one of them could protect money you spent decades building. Most financial disasters don't begin with bad decisions. They begin with missing information. Nobody calls to explain these rules. Nobody sits down and walks retirees through the risks. The system simply keeps moving forward until a mistake becomes a problem. Today you've learned how transaction patterns can attract attention. You've learned why preparation matters before large withdrawals. You've learned why address changes matter, why deposit protection matters, and why joint accounts deserve a second look. Most importantly, you've learned that many of these problems are preventable. The goal isn't to fear the system. The goal is to understand it. Because once you understand it, you can protect yourself. And if you know someone who could benefit from hearing this, a parent, a sibling, a neighbor, or a friend, share this video with them. One conversation today could protect money that took a lifetime to earn. That is exactly why this channel exists.